Thank you so much, Juliet, and thank you for inviting me today. It's really a pleasure to be here. So I lead the research team at Willis Towers Watson. We're an investment consultant, and the research that we do is very much practical, how to help our clients' pension funds build their portfolios, finding great investment ideas for them. And it's fair to say that the last couple of years, ESG investing has pretty much hijacked the time and resources and attention of my team. So it has become very, very important. So if I can go to the next slide, there are obviously a lot of parallels and themes will resonate across different speakers. I'm not going to repeat what has already been said, but it's probably interesting considering cross-national perspective just to touch upon what factors have prominence in different geographies. So I'm based in the UK, and here when you start talking with clients about ESG, pretty much within 5 seconds, you start talking about climate change. Probably because of COP26 here, there may be other factors, the regulation here, but climate is very much at the top of the agenda. If we go to Europe or Australia, or indeed Asia, Japan, then it is much more balanced, although climate change will also be very, very high on the agenda when we discuss various ESG factors. And in the US, again, probably not a surprise that social and governance factors are much more prominent: inequality, diversity, board structures. And it's probably just this year, after the very welcome re-entry to the Paris Agreement, that climate change has also started going up in the agenda. Now, if we can go to the next slide, one thing that I thought could potentially be useful, considering that we are a pension consultant, is to put the size of pension assets in perspective with the size of ESG investments, and just demonstrate what sort of influence this capital could potentially have. We have this think tank called Thinking Ahead Institute, and we run surveys of global institutional investors every year. So these numbers are very recent, as of the end of 2020. Global institutional asset owners control $154 trillion. And the largest group in it is pension funds, 40%, $57 trillion under control. To put it into perspective, the size of the global economy in 2019 is 88 trillion. And also, if we think about what is current size of the ESG investing problem, the public commitment from governments earlier this year in January was $4 trillion. This number is increasing very quickly, so probably now we are at the end of April and this number is already higher. Or a widely quoted number, what is the current SDG spending gap, so as to be able to achieve them in the defined time frame? It's $1 trillion. So these numbers are staggering. But compared with the size of the global pension pool, it's actually, you can see how this pool can make a difference. Also, a couple of other points that I would like to mention is that pensions are actually growing very fast. 11% last year, 15% the year before that. The move from DB to DC, which means that the whole concept of longer term horizons and some of those horizons become indefinite, is increasingly becoming more important as DB is winding down. Also, pension funds are becoming much more familiar with global investing and with alternative investing, which again makes them much more equipped to invest in ESG. Now, if we can quickly go to the next slide, why pension funds invest in ESG has been covered multiple times, so I'm not going to go into the detail, but I would like to emphasize here that the business of pensions is managing pensions. And as a result, investing in ESG is relevant, but it is relevant when you can still fulfill your main purpose of securing financial wealth and future of your members. So risk and return is hugely important. And from this perspective, we can go to the next slide. Climate change presents a really interesting example because in our view, it has clearly become a financial risk and financial opportunities. Governments around the world have set themselves targets and they are determined to meet these targets of moving to a carbon neutral economy. This means that there will be a massive transition which represents financial risk and financial opportunity, and pension funds should be considering, must be considering it if they want to deliver superior risk-adjusted returns to their members. And there are interesting aspects there in this type of investing, which pension funds are not really familiar with. Maybe some of them. Yesterday, there was a conversation about universal owners. So they are probably a bit more used to thinking in a systemic way. And when you think about climate, it is really a systemic type of investing. You can exclude thermal coal. And it's probably in the short term a sensible decision to do, but does it going to change the way your overall assets are going to look in a decade? Probably not. And this is where you need to think not only about your portfolios, but of the impact of your decisions on the overall system. Then this concept of intergenerational equity and fairness across generations, it's really important for the whole topic of climate change. And pension funds are probably, if there is one single entity that has to think across generations, it is pension funds. And clearly not all of them are thinking this way about future generations. Engagement, I think and stewardship, I think it was mentioned a couple of times before that if we want to really take advantage of the change in the economy, then you cannot be a passive investor. You have to be active steward of underlying assets. And as a result, engagement is becoming a critical capability that pension funds need to acquire. And then primary investments, primary capital. There are lots of opportunities there. So renewable energy, electrification of transport, reforestation. Yes, they're still small in scale, but I'm pretty confident that this area is going to grow. And the investment profile of this of these investments is really good for pension funds. Yield, stable cash flows, this is what you need for your liabilities. If we can go to the next slide, quickly touching upon the role of asset managers. That's obviously a critical link in our investment value chain. You have 6 asset management professionals for 1 pension fund professional. So you obviously need to make sure that if you want be successful and deliver good results to your members, is that this relationship works well. And I make an argument in my paper that at the moment this relationship is very transactional. It's pretty much hiring and firing at the click of the fingers, very short term. And what this relationship needs is to transition to being more strategic. And in this instance, we all can benefit from having longer time horizon, better aligned incentives, and also encouraging asset managers to spend more on operational stewardship capabilities rather than just trading decisions in and out of assets. And for this to happen, it's really voice from the top, from pension funds, is clearly needed. And now if we can go to my last slide. So is there a better way? And what I argue in my paper is actually that it is pension funds who need to think about a big transformational change in the way they do things if they want to both protect their portfolios from the ESG risk, but also take advantage of investment opportunities from the changes such as climate change presents to them. And what this transformational change involves, it is obviously a lot about culture. Our clients, especially in the last year, have found it very beneficial to go through their purpose, their mission, their investment beliefs, because they are changing, they are evolving. And they do require a certain change in the mindset. Thinking about time horizon and whether your behaviors and the way you make decisions is aligned with the time horizon of the assets that you manage and your members. And then usually what it leads to is to certain changes in capabilities and operating model. Do we have the right people on board taking the right decisions? Do we have enough diversity in our decisions? And also, do we allocate our time right when we spend our limited resources? So all in all, this adds up to a pretty significant change and transformational change. You cannot really do it incrementally. And I argue that this change is actually for the benefit of the whole system and would allow us to continue deliver positive outcomes for our members. Thank you.